Good morning, everyone, and welcome to the European crossover webinar. And we've seen the dollar ease off from its better levels. We've also seen the bonds come up. We actually came into a level that many of the guys were talking about yesterday afternoon, the next potential key area, which was 49.09. We backed away from that a little bit, but my thoughts, once again, where you have to be a little bit careful today. I don't think we're seeing any reversals or anything, but you may see a little bit more evening up of positions, I would think. Maybe not evening up, but just a little bit more of a give back. I kept I was saying yesterday morning, I thought the move post FOMC would only last 24 to 30 hours. And, we did come into that support. Well, we came into that initially, we bounced off of that level, that 127% extension, which on the euro was 404. We dipped below it. There was no, follow through there on that dip where we did make it actually down to about 370 or so, and then we've seen a pretty decent rally. Came into some resistance here on the euro here in Europe, and we had that level at 472. That's actually, and it's just a couple of touches, and the market's pulled back. But my take is you got to be a little bit cautious. I don't think we've seen a big major move, but we could shake the trees a little bit. It's going to depend on the bonds. If the bonds can move higher, that could open up the door for us to make a little run here in the other dollar pairs. We'll go on and get into the news. Essentially saying the same thing. The euro, yen, and pound all recovered some ground against the dollar on Friday after slides of up to 3% in reaction to the Fed's outlook for U.S. interest rates. Market headed into the Fed meeting on Wednesday expecting little chance of another surge in the dollar before the end of the year, but instead upping of predictions for the number of interest rates next year brought parity with euro back into play and took losses for the yen from its peak on the U.S. election night in November to just over 17%. It's Friday and we've had a busy week. I'd be surprised to see the euro push below 104 today, says Niels Christensen, a strategist with Nordea in Copenhagen. I still think the risk is to the downside, but from here we move into year-end. The market will be less liquid. Many bank forecasts for the major developed currencies have been blown out of the water by moves of the past 36 hours. Only 10 of more than 50 polled by Reuters earlier this month forecast the dollar reaching parity within the euro within the next 12 months. On Thursday, that threshold was just over 3% away. But given the scale of moves in the past month driven on by volatility around last week's ECB meeting and the Italian constitutional referendum, many players may now be content to walk away until January. One risk to that scenario is a squeeze on the dollar liquidity around the year end. The one-year cost of a dollar funding for European banks called cross-currency basis swaps is back within a side of four-year highs hit at the end of November. I'm going to be watching the year-end very closely, said head of trading at one large international bank in London. If it gets much worse, it may create more of the sort of pressure we saw on the dollar earlier this year. Nordea's Christensen also pointed to the risk highlighted by October 10% flash crash in sterling that a large order could move prices sharply as trading volumes fall over Christmas holiday. The dollar is up 2% against both its New Zealand and Australian dollar equivalents and the Chinese yuan. With a weaker renminbi, one of the big calls of many international banks for the next year, all eyes are on how much more weakness Beijing will tolerate a year after a speculative run on the offshore version of the currency. And here on the pound, sterling traded close to a 3-week low against the dollar on Friday as one was on track for a second week of losses, weakened by the greenback's sharp rise on expectations for a faster than anticipated increase in U.S. interest rates. The U.S. currency soared to 14-year highs against a basket of currencies this week after the Fed on Wednesday hinted that rates could rise 3 more times over the course of the year, up from a forecast of 2 hikes at the Fed's September meeting. Sterling already weakened because of the Brexit concerns, skid along with other currencies, hitting a trough of 23.78 on Thursday, its weakest since November 3rd. The main story this week has been the dollar strength on the back of the more hawkish signal from the Fed. So that's leading to the broad-based dollar strength as the market prices in more tightening, said MUFG currency economist Lee Hardman. The pound has been stronger over the past week, registering its best month in 8 years in November, and threatened to break back towards the 130 for the first time since the start of September, as worries that Britain will lose access to the European single market currency. The pound is still very undervalued from a long-term perspective, so there's obviously a lot of risk and uncertainty already priced in at these levels, said Hardman. Against a euro that was stronger across the board after its steep falls on Thursday, the pound has tumbled over 16% in the wake of the Brexit vote, but has since recovered almost half of that and is now around 9% weaker before the EU referendum. The Bank of England says this could soften an expected surge in British inflation next year. With the BOE reiterated the two-way risk policy, it seems that the markets remain set in an inflationary nutter mindset and continue to view the bank's recent GB pound-induced inflation concerns as a hawkish shift, said ING currency strategist Viraj Patel. Cyclical divergence between the UK and the US economies is becoming more apparent and is likely to drive sterling below 120 in 2017. So let's see what's on tap today. Building permits, housing starts, and that'll be it. So let's go and get moving into the charts. We've talked about this 127% extension on the euro, and we came down there and actually hit it to the pip, and then we bounced off it. Obviously, we ended up testing that 104 as we got past that, and there was no follow through. We got a little bit of a hammer here on the 2 hours. Since then, we've worked a little bit higher. As we came into this area around the 473, and we're going to take a look at that real quickly. So you can see that we rebounded right here into this touch. I guess I should just go on and mark it off. It's 472. Now, my thoughts is if the bonds do pop up, and I was talking to some guys, and if we can get a 4-hour close above 49.11, 149.11 on the 30-year bonds, that'll neutralize the downside pressure. Doesn't mean everything's blue skies ahead, but it neutralizes the downside pressure and probably open the door for a little bit stronger correction. So this morning when the bonds started moving up and got up to about 49.09, that really opened the door, and we got this spike up here. I don't know, maybe more of a mini spike, I guess. But I think that's what you have to go in and keep in focus. Now we're pulling back. We're 48.29 on the bonds. There's a little bit of support here. We're coming into support. It's actually going to be 48.28 on a very, very short-term basis. But this is what you have to go and keep in mind. And I think since we got the pullback, we didn't get the follow through beyond 4 on the euro. I don't think we're going to go in and see some big massive move today, but I think we are open to going and seeing a little bit of the liquidation where people, there was no follow through. So my whole thought was that I didn't think we would press too much further. That's why we had mentioned the 404 being a target when we got on that 127% extension. And I think that really opens the door for us to potentially move higher in the currencies. And I think it would more or less the people that would short up against here, I think that we would just be tripping stops. I don't think it's anything major that you'd see some screaming run in the euro, but I think the people that have tried to take on positions here would probably goose those stops. And on a decent run in the bonds, if we do get that, it's been I wouldn't say it's been all over the place, but we've seen some hefty moves in the bond market. And since yesterday, we've been steadily working higher. But I think that we could trip those stops, and that would open the door easily for this 105 and potentially up to this 525. And I think that you have to be cautious on that. And we'll quickly pop into the bonds to give you a quick look there and what I'm referencing. Now we did get a buy signal here in the bonds, on the moving averages, on the crossover, and that's continued to follow through. You can see it's been a steady progressive climb all the way up. And I shared this chart yesterday, on Twitter. I talked to some people about this. I said the first key area here, I think was going to be this 48.23, and that was actually confluence at the time with 48.21. Which was the 50% of the move, and you can see it stopped, dead stop here at 48.22. So we're looking at 48.23 as this zone here, and 48.21 being the being the 50% retracement, and we went right dab in the middle, one tick off of that area, and then we saw a pretty good pullback down here before ensuing. We got just above it, and once again we failed from that area. Pretty good pullback overall. You look at it as close to almost a full point. But once again, when we look further back here at this 47.06, that was huge support here in the bonds, and I thought that move was really stretched at that point. We looked at yesterday, it was even discussed with the PIPSAR. I thought this was a very key area, this 47.06. If you look at it, just a minor support, we break it, opens the door, then it becomes resistance again. Once we get past it, we come back to test it, it holds, then we see a very nice rally. And when we get past it, the market still overall holds in this area. We make a new high, we come back to test it again. So this 47.06 was solid as a rock. And you can see as we came down here, we were able to take it out by 2 ticks. And then we start moving higher. Now, I just think that we're just overdone here. I don't think that we're going to see some unbelievable correction in the bonds. I'm not even thinking 38%. Maybe we could see like 23%. So just to give an overall look, if you were to look at this, I think we'd be doing great if we even got 23%, to be honest with you. And that would be, you see right here? So I'm not even looking for anything like this. I'm just looking for something like this, a 23% correction in total, and that would take us to about 53.24. So still a pretty good move here, but if we can get it past 49.11, and my thoughts are just that it's just you got the news is about as bad as it can go and get, so you got pretty much everything baked in the cake. If we get past 49.11 on a 4-hour close, that's going to negate this downside action. It doesn't mean we couldn't come back down, but I'm saying it's going to negate it in the sense that the market's going to be, at that point, the glass will be half empty. I mean half full. And people will be looking at, hey, where can we go to? And the big bias pivot, I'm talking about the big one, would be right here at 51. So if we get past here, my take is then they'll be looking at, okay, we got to take out this high. Probably on a very short-term basis would be this touch right here. The market would focus in on. You see right there? That's probably, and that would actually take out the highs here. So that take us, another point from here. My thoughts is then we'd be shooting for somewhere in between here, and then that'll allow for a little bit more concerted pullback. So I don't think we're going to turn around and just go gangbusters, but once again, I think you could see some short liquidation. And it may just be a little bit of a stop run on positions here, but I think it could allow us to get past this 49.11. And what I was telling some of the gentlemen was, be cautious, on any long dollar positions. I don't think we're going to see some big move today, but I think that what I was telling them, I think we can shake the trees. So you have to be a little bit cautious with that. I think that this opens the door for some liquidation here that could pop us up beyond this 49.16. So you got to be careful there. We were talking about the 525 on the 30-minute on the euro dollar. Obviously, the big key number really here on the 2 hours is 519. I'm not saying we're going to get there, but I'm saying once again is that if the bonds get going, and then like I said, we can shake the trees and probably goose some stops. I don't think it's going to be anything major, but we can goose some stops and make it run. And I think it'll just be the people that took on shorts, or maybe it's been short from down here, will look, wow, if it gets above 475, then I'm out. And I could just quickly, 475, I'm out. And quickly Sparkle will run past the sell 5. The next bigger market has got to be this dollar yen. And so we have these two shooting stars coming up here. And the market's hanging around here, hanging around. In regards to the dollar, same thing. I'm still of the ilk, although the Reuters article said that a lot of people in the poll were wrong, that they had, polled, I think it was 50 people or something like that. But, I'm not saying people weren't short dollar, but I don't think it was people were heavily short. So the move that we got post the press conference, or ensuing with the press conference, once we got more than halfway through, I think was justified because you had to let the market go. It was going to go, but I don't think that they had the market. The market was completely wrong-footed, because if it had been wrong-footed, then we'd probably see the euro closer to around 350 right now. And then it's like, how much further can it press? Can we go to 2.5 by today? So the move was justified, but at this point, that was my whole idea with the target of 404 being the 127% extension, and that actually held initially to the pip, and then we saw a nice rally after that, like, I don't know, about 35 pips or something. And they tested it and got below it. Now they're back above it. So we'll have to see. I think that we'll get a dollar correction, and I don't think it's going to be huge. And that was my whole point about the deal with Yellen and not saying anything about the dollars. That now, if the dollar, gets a little correction, which I think we will, it's the corrections is going to be from way up here in the stratosphere. So if you're looking at the euro, people are ready to probably pounce on the euro and then you move towards 575. So that's my take, is that it's really, without Yellen saying anything, it's going to be really tough to get corrections to the dollar. I think we will at this point because we stretched a little bit. But when we're looking at this dollar yen, We're still keeping these levels up here for the time being. I think once again, it's all about the bonds. If the bonds can, you need to keep your eye on these 30-year bonds. If they can get past this, the highs, which is the 49.09, we point out earlier in Europe. If we can get past this 49.11, it's going to spook the market. And like I said, I think that we could shake the trees. We'll take a look at how far they could go and pull back. Let's see. Oh, for starters, it looks like this 1729. I was actually following it in Asia not 2 days ago, and I've taken a short position, and I covered half actually right here in this area. I was actually looking for the market to break down to 1708. If we were to shake the trees, this 1729 would be the area that they would first, I think, that they first tagged. They actually, at that time, I remember I took half off there and I tried to let the other half run to 1708, and then I put a stop just to protect the profits for about like 5 pips or something like that. But anyway, they tested it twice intraday. I'm saying like with, if you look at the 5-minute chart, they tested it, and I think they made it again to like as low as, I don't know, 1722 or something like that. So that's what they probably shoot for. If you get the market, if the bonds were to start ripping, you scare the market. Other than that, there's obviously not a whole lot happening. They're holding these levels right now for now, and we'll just have to see how the day plays out. If we can get a little bit of an upside move in the bonds to shake the trees here in the dollar yen. I wouldn't, here's the concern though, I'll tell you what. If you're short dollar yen, you want to take a look to see if we get, move in the bonds. And the bonds are weakening a little bit. We're coming into, like I said, that interest support here at 48.28 on a very, very ultra short-term basis. And early in the U.S. session, if we can get the bonds, I'd say really no later than 11 a.m. Eastern time at the latest, you'd want to see the bonds making a move towards their highs. If it gets later than that, the people are going to, it's not that it couldn't happen, but people are going to start questioning whether the bonds can even, rally at that point. But if we can, by then, and we get the bonds zipping up, then that'll open the door for the dollar yen to go lower. But as the day wanes, and let's say we're not doing that, or we're just hanging around 48, maybe the bonds will go higher, maybe they won't, then you're probably going to get an upside bid because some people will be needing to cover. And as the day goes on, you'll probably just see this thing with the bid going higher and higher and higher. And by the time you get to about 1 Eastern in the U.S., then you're probably close right to the highs, and then maybe you get a bounce up here as you get beyond that. So it's just something to be cautious if you are short dollar yen and you're thinking, wow, I don't want to hold it over the weekend, then my take is you really need to see these bonds moving by no later than 11 a.m. Eastern. They should be giving you an indication that, hey, look, it looks like we're going to make a run here in the bonds, which should open the door for the dollar yen to come in. I know I talked to one guy who was yesterday on the webinar, I remember who it was, and he had asked, and he was short. And I said, hey, did you think you can get back to 117? And we broke, and we said, you don't want it to get back above 1830. And we were talking about this. I said, you don't want to rush it. Let's see how it closes today. And this is if your short dollar yen was, favorable here. And we're still hanging around here, but still within this range here of these two shooting stars. But you need the bond market, and we'll go back to that quickly, just so anybody that, like I said, that one gentleman was short. You can see we came right here into this 48.28 here. That was actually, you see, this is where the market had rallied to, came back, rallied again, pulled back. It needs to go and hold in here for now, but by the time 10 a.m. rolls around, Central Standard Time, or 11, you need to see us right here where you're thinking, if you people are short the bonds, like, uh-oh, it looks like we're going to get stopped. And you need these bonds, and once we can get above here, this is where you can shake the trees and allow the dollar yen to come back in. If not, if not, then like I said, as the day wanes on, then you can see a steady bid in this dollar yen at that point. Because you can see here, as we're at 48.28, we're in the high on the bond on the dollar yen. And I think people will give it a chance, but as the day lingers on, then you see how we're now at the highs right here. You'll see this. You see, as the day lingers on, you're going to continue to get a bid then if these bonds don't come back up and offer that opportunity. We'll go and take a quick look at the cable. It's almost time to go on break. We're working a little bit higher in the cable here. In this dip, I would have thought that they would probably come down to this 23.62. And I haven't paid that much attention to the cable. But I would have thought it would have at least come down here and tested this. It came very close. We'll take a look at it. 23.76, so obviously very close. But I would have thought they would have been able to just tag this and go below this. And definitely on the way back down, I would have thought they'd been able to trips and stops. Dollar yen worked a little bit higher because we're at 48.27 on the bonds. So they're trading hand in hand with the bonds. So just going and keep an eye on that. Bonds are into some support. They need to go and hold them here. But as I said, if you're short dollar yen, you really need to be keeping a close eye on the 30-year bonds. And we're into support now. But if we can get above that 49.09, which was the morning's highs, then that'll spark some short covering and can shake the trees here in the dollar yen. But anyway, getting back here to the cable. It's trying to make this hold, and I don't even have a good take on what the cable wants to do, other than we did come down into this area here. This 25 is very key. They tried to bounce it off the 25.30. I think once again the 25.30 would be key on the way back. If we're going to see, and like I said, I think we'll see a little bit of a dollar correction, but I don't think it's going to ensue until next week. The only thing I think today is, based on what happens with the bonds, we can see them shake the trees a little bit. And right now we're at 26 on the bonds. We can shake the trees a little bit, but I think that's going to be about it. So, like I said, you got to keep an eye, keep it on the 30-year bond. That's going to give you an indication. Surprisingly, the euro hasn't backed off very much. You can see the yen working higher. And I think, let me jump back here to the euro quickly. If you think about it, this has been a pretty good run all the way up here to 472. And you know what? They're not backing off that much. And yet the bonds, they're trying to hold these lows, but they've dipped lower. And you would have thought that this euro would have come down here in light of the move in the bonds. I mean, you're seeing the dollar yen, which obviously trades very closely to the 30-year bonds. But this is surprising right here that we haven't pulled back that much. So once again, I say be cautious, is that if we can get the bonds, we're into support, to rally up, then like I said, I think it'll shake the trees and could let us run up here easily past this 105. Yeah, Scott said, did you say the 25.30 is I didn't say it was. Piece is a possible top for a retrace. It's a possible move. We'll get back into the cable, and then we're going to take our break. Hang on. Yeah, this is at 25.30 right here. You see that here? Because obviously the 25 is very big, and people are going to use that as a marker. But my thoughts is they can easily shoot past that. So you can see these touches right in here. So this 25.30, I think the door is open for it to get there. Let's say that the dollar doesn't really do anything as far as correct today at all. Nothing really happens. The bonds kind of sit there and languish. Then if we start to see a correction in the dollar, I think it's going to be minor. And that was my whole thing from yesterday, because my point was we've gone so far with the dollar now that when Yellen didn't say anything, yeah, the dollar will correct some, but the corrections are going to be exceptionally shallow. I mean, those days of 108 euro, you can kiss those goodbye. Like I said, those are long gone. So yeah, on the move back, yeah, this 25.30 is what I'd be looking at. So if we were to start to get a correction next week, then you could, let's say you were long cable, then I'd definitely be looking to lop off some of them here at the 25.30 as a general target of where they could initially go to. I'm not saying, oh, once it gets to 25.30, oh, the wheels are going to fall off the caboose and we're going to make new lows. No, I'm saying is if you're long, this is the area where I would look. They'll struggle a little bit at 25, but they'll probably shoot past that. And here's where you start to see some people lay off longs or some people trying to apply some shorts. Anyway, it's time for break, so we'll catch a break and then we'll come right back. And thanks for joining us here on the European crossover. Okay, everybody, and welcome back to the European crossover. And we're getting we were talking about the bonds. We're saying they were right into support. Here we focus on intraday scalp moves or more closely tied there. You can see here, we talked about the 48.28 right in here as coming into support. We dipped as low as 26 and we saw a very nice rally off of that. See here, so very nice rally so far. This is the one thing you want to keep an eye on. As I mentioned, if you, let's say you're short dollar yen, I know one gentleman was yesterday, and I think it's going to be key because like I said, as the day goes by, if people are short that, you're going to have to really see these bonds move higher, and we're seeing that right now. If we get above 49.11, as I mentioned before, on a 4-hour close, that opens the door. This would negate the downside. If we get a 4-hour close, generally I go with 2 consecutive 4-hour closes, but I think on a very short-term basis, 4-hour close above 49.11 negates the downside. It just opens the door where now the market is looking, okay, the glass is half full, how far can we go? And then this 51 comes into sight. And then people, I believe, at that point start, instead of trying to short the bonds, they're looking to where to buy the bonds on dips and seeing how far they can go in and get up here. Yeah, Max says he likes the music. So let's go in and move back in the 2-hour charts. Dollar yen still hanging around these highs up here, despite the bond's going to come back a little bit. So something we're going to keep an eye on. We were talking about the cable a little while ago. You can see it still remains under pressure. And that's what I was saying is we may not see, and the euro's working a little bit low. The dollar's a little bit under pressure right now, despite the rally back we're seeing the bonds, because we're seeing the euro right now at 441. I think the low right now was 440. So they're going with this for right now. If we go and get, and I think there's a possibility we're going to get a little bit of a dollar correction next week. I don't think it's going to be a whole lot. Then I think that this is where they would shoot for, which is 25.30 on this cable. I'm not saying we're going to see that today, but I'm saying is if we go in and get this dollar correction, and it's going to be minor, let's make no bones about it. After Yellen didn't say anything, that's what I'm saying is that with her not saying anything, the dollar was going to go on a rip at that point. And now, can the dollar correct? Yeah, it can correct, but the corrections are going to be shallow. Like I said, the days of 108 euro, those are long gone. Those are out with the horse and buggy days. So you can forget about that. They'll probably be people probably tripping over themselves trying to sell any move at 575 or 106. So Can we get a correction? Yeah, but it's going to be very, very shallow. Um, we'll take a look here at the dollar Swiss. We got a very nice little shooting star here. I mean, when I say a shooting star, because the wick could be longer. Okay, it's just the same thing like I was talking about with the dollar yen. At least in this situation, it looks a little bit longer. Usually with the shooting star, you're going to see the wick even further up. It's definitely not a. You could almost say in comparison, you could almost say it's more close to a gravestone doji. But the moves that we've had in the dollar, then you can say, yeah, this looks closer now to a shooting star because the moves have been so big. But so I think, like I said, going into next week, you're going to be looking for just that. Is people will look to go in and buy the dollar, but I think that they're going to wait until they get a little bit of correction. Obviously, the key thing is going to be the 30-year bonds. But taking a look on this dollar Swiss, one of the key things that's going to be is going to be this year in, and so next week will be pretty key. I think you have to be very nimble with the dollar. Because with that, as we come closer to year end, people have been worried about that, and that is correct. The flows and whether people are going to be having to rush into positions. And we came right here down to the 23% correction. See that? And they bounced up. This is what I was talking about, is that I think the moves are going to be very shallow. Do I think we'll get a correction? Yeah, I think we'll get a correction, but I think it's going to be shallow as all get out. So that's what I think next year. It's going to be very tough on the U.S. economy by the end of the first quarter. I'm not talking about next week, next month, but by the end of the first quarter, you're going to see where this dollar rampage is going to go and take its toll. And I think everybody is going with the, I was going to say drunk on the Santa Claus rally, and I saw here where someone posted that even the DAX is making new highs. But once we get into after the first week of January, I think you'll start to see people strategizing, and I'm talking about their positions or their holdings, thinking, wait a minute, this dollar on a rampage is really going to affect multinationals, and I think you'll start to see the market pair in. And maybe pairs in just a little bit at first, but I think we'll see a decent correction then. Nothing wrong with the market overall. I'm talking about the SPOOs, but once we get into this first week of January, I think that's where you're going to start to see people very concerned. Yeah, I see some comments regarding the situation with Greece. Merkel says we'll discuss the Greece bailout program in talks with Cyprus today, but no decisions expected. And you can still see that even though the bonds have come a little off lows, the dollar yen still remains fairly bad. And I think, like I said, there are people that obviously they're short, and the market's aware of that. And unless we get a nice little pop in the bonds, it's going to be tough here to go and get this dollar. Not that it can't happen. Technically, we're saying, well, we could go in and pull back. But I tell you what, they need the help of the bonds, and they're going to need these bonds to go in and start to make them move higher. So I think this morning it's going to be critical that the bonds, for moves in the dollar yen, if you want to play the long side, you can play the long side, but it's going to be critical. That is one take even there. If you're looking to play the long side for the dollar yen, is you want to look at the bonds also, because my take is if the bonds haven't seen a pretty good rally, by the time we get to 11 a.m. Eastern time, then you could actually start to take bets, being long the dollar yen, figuring the people that are short are going to have to pay up, and the closer we go, it's just going to fuel more people looking to go even out of the positions. So you want to keep an eye on those bonds. Those bonds need to make that rally. If not, like I said, you could go in and play the dollar yen for the long side, figuring there's going to be some people that are really stuck and they're going to need to pay up, and we could just start running with this thing. So keep your eyes focused on that 30-year bond. So we took a look at the dollar Swiss. We'll take a look here at the gold market. I don't think we got to that yesterday. And we came into some nice support. I thought we were going to make it down to 2260, and we came a little bit short. I had mentioned this the other day about this 2870 being very key, and you can see how that held up really well. I mean, it obviously worked almost like a pivot. But I thought yesterday that we had a pretty good chance to make it down to 22. I thought we'd be able to make it down there and then get a quick pop back. And the market tried to rally initially off of that 2870, and we just couldn't get any juice to the upside, so it started sliding back. And I thought this fall here would take us down to 22, and I thought that was going to be a quick area where people exit out of any shorts they have, and then we see a quick $4 or $5 pop immediately, and then maybe a steady progression higher. And we just didn't quite make it to 2260, but this is a pretty key area here. Once again, it's going to be dependent on, to a certain extent, what happens with the bonds. Although when the bonds, the gold was looking rather sickly yesterday, because when the bonds were steadying and working a little bit higher, the gold really couldn't get out of the way. That was right here. And I thought, you know what, they're going to come down here, they're going to take out this area, and they should be able to gun the stops and run all the way down to 22. And actually, when they took out that area, they just continued to drip lower and drip lower and drip lower. And once it got past 25, we started to see the market going to come back. But I was looking for actually a quick dump into that 22, and I thought we'd see a very nice snapback of $4 or $5. And then I thought we'd see a steady progression high after that. So it's still a little bit of a mixed bag. I think they're keeping an eye, just like that. To a certain extent, the bonds keep an eye. The gold is keeping an eye on the bonds. I really, once again, some of these markets, I don't see a lot happening until we get into next week. Only thing is, like we talked about that, once you get into next week, now you're going to be concerned about as we go closer to month end. But to me, today, whether you're trading gold or whether you're trading the currencies, I think the big market today, I can't emphasize that enough. I'm going to go back to that again, probably sound like a freaking broken record, is going to be this 30-year bonds. And we did flip to the buy signal here. We came into some very key support yesterday. This was 4706. I'll go back into that again. You can see that here. So I think that we can see a correction next week. But the key is going to be today, and whether we can see some effect to happen here on the euro and the yen, to a certain extent the gold. Gold's actually been lagging. But the key today is, and we talked about this yesterday, I said this earlier, when I was telling the gentleman about 48.23, and we saw a very nice reaction against the 48.23 and a sell-off, and then we took it out by a little bit, and then another pretty big sell-off, almost to a point. Full-point move. But I said the next, when I was talking to some of the guys, when I mentioned here, I said the next key target is going to be 49.09. And I wasn't sure if we could do it in this session. Probably not. But we actually did do it here earlier in the European session. We came up here. I was actually telling the guys, I said, hey, we're here at the 49.09. And a couple of guys got short the boon. But here's the deal. If we can get past this 49.11, it's going to open the door for higher. So for today, whether you're trading the yen, the euro, or the gold market, obviously to a certain extent, maybe even cable, the key is going to be if the bond market can get past 49.09, I don't think sparks a massive rally or anything, but I think it's just going to allow the market to hit some stops and probably get a quick run up here. And then that's what I was talking about in the euro or the yen, maybe to a certain extent, lesser extent the gold. You can see a little bit of shaking of the trees. I just happen to have the dollar Mexican peso, the Mexican peso up here. I'm going to just switch off. We were using this, if you remember, to kind of track how the dollar yen was going at the time. Let's go on and drop in back into the dollar CAD. I have not paid attention to that lately, or in the last day. We've seen a very nice rally back here in the dollar CAD. The key thing still, once again, is going to be the top of the zone, this 33.88. You can see where the market had that phenomenal rally and then took it another extra leg on the back of the FOMC. Once we got up here, we got a reasonable pullback from this area here against the top of the zone. And you can see I just try and go by the touches. So in this case, obviously with the big move of the FOMC, you're going to see some very nice overshoots, and we did. But it's in this general area where the market, and you get, and especially on an event like FOMC or post FOMC, your stops are going to have to be a little bit wider to allow for the market to breathe a little bit. So we saw a decent pullback. We'll work a little bit higher as the dollar works higher. Obviously, crude's been under pressure. And continues to remain under pressure, but like I said, it's crude's fallen quite a bit from where we were at the beginning of the week with the announcement of the cut with the non-OPEC countries. For me, and like I said, it's all about 33.88. I think that we will get a little bit of a correction next week. I still say, is like I said, we'll get a correction, but it's going to be very shallow because at this point, I think people will be trying to buy the dollar back on any kind of a reasonable dip. Nobody's looking for any major pullback whatsoever. I think even a 38% correction is probably asking too much. And Blake should be coming on just a second, so hang on.